The global energy market is currently facing a seismic shift following Iran's recent maneuvers in the Strait of Hormuz. While public attention often remains fixed on oil, the real crisis is unfolding within the natural gas sector. Following the blockade of the critical waterway, natural gas prices in Europe skyrocketed by 60% in just 2 days, creating a dire situation for a continent already struggling with energy security. The Strait of Hormuz serves as a vital artery for the global economy, with approximately 20% of the world's liquefied natural gas passing through its narrow waters. Unlike oil, which has alternative transport routes such as Saudi Arabia's east-west pipeline to the Red Sea or similar infrastructure in the United Arab Emirates, natural gas has virtually no backup plan. Most liquefied natural gas from the Persian Gulf region, particularly from Qatar, the world's leading exporter, is almost entirely dependent on maritime shipping. Qatar accounts for nearly 19% of the global supply, and over 80% of its exports must transit through the strait. Furthermore, natural gas is significantly more difficult to store than oil. While many nations maintain strategic petroleum reserves to weather short-term disruptions, gas storage capacity is comparatively limited. This means that a physical cutoff in the strait translates almost immediately into a supply vacuum for the global market. The impact is felt most acutely in power generation, heating, and industrial manufacturing, posing a direct threat to both the economy and the daily lives of citizens. The pain of this crisis is distributed unevenly across the globe. Asia, the world's largest buyer of liquefied natural gas, is facing a severe physical shortage. In early March, the benchmark spot price for the region more than doubled compared to the previous week, reaching over $25 per million British thermal units. Nations like Pakistan, Bangladesh, and India are particularly vulnerable, as they rely on the Gulf for 99%, 72%, and 53% of their respective imports. Europe, meanwhile, faces a crisis of affordability. Although direct reliance on Qatari gas is relatively low at 7%, the continent is now heavily dependent on the global spot market to fill the void left by the absence of Russian pipeline gas. With 20% of the global supply suddenly removed from the equation, European buyers must compete with Asian nations for the remaining 80%, driving prices to unsustainable levels. Complicating matters further is the deteriorating relationship between the European Union and Russia. In late January, the European Union passed legislation to completely ban Russian pipeline gas and liquefied natural gas by the year 2027. In response, Russian President Vladimir Putin suggested that Russia might preemptively cut off supplies to Europe before the ban takes effect, arguing that redirecting gas to emerging Asian markets would be more profitable. As the Islamic Revolutionary Guard Corps continues to restrict vessels from certain nations from passing through the strait, the threat of a total gas cutoff looms. For Europe and Asia, the coming weeks will be a test of economic resilience as they navigate a world where the primary source of their energy is under lock and key.